Let's take a look at some metrics and indicators for risk. The most famous or infamous one is VAR, or value at risk. This is heavily used, but it's a complete black box with no transparency, and it can also be manipulated, and it doesn't work in the worst case scenarios. We'll also take a look at some alternative risk measures, such as standard deviation, downside deviation, months to earn back losses, and others that aim precisely to mitigate the downside of VAR. Let's cover all of these techniques. In terms of actually measuring risk, the most used measure is something called VAR, or value at risk. Although it has its limitations, and they are big, it's important to understand it. Not just this one, but other indicators of risk as well, and some measures. First, we want to understand what VAR actually means. Put simply, value at risk represents the maximum estimated loss at a certain confidence level. For example, a maximum loss of 100 million at a 95% confidence level, which means that in 95% of all cases, no more than 100 million will be lost. But as we'll see, this is also the biggest shortcoming of VAR, because outside those 95%, there is absolutely no prediction and no ceiling to what can be lost. So in those other 5%, you can lose 100 million in 1 cent, or you can lose multiple billion, or all the money in the fund. Then, other types of risk indicators that can also be used, usually to make up for VAR's shortcomings, including the largest losing month of the fund, the number of months needed to earn back losses, and more. And finally, it's important to understand what are some internal indicators of risk that are not related to the market, but the hedge fund itself. We've covered liquidity and leverage, for example, but there are other ones in practice, such as position concentration, unhedged positions, and others. Let's start with VAR, or value at risk. As we mentioned, it represents the maximum loss for a given confidence level. For example, a maximum loss of 5 million in 95% of all situations, which means that only in 5% of situations will an investor lose more than 5 million. But it does have its problems. The first is that it doesn't include the tails of the distributions. By this I mean, consider a Gaussian distribution, a normal curve. That interval of 95% is most of the curve, so it's two vertical bars that cover most of the distribution. But the extremes are excluded, what's to the extreme left and the extreme right, which are known as the tails. And these can fluctuate a lot. So for example, if the maximum loss is 5 million at a 95% level, okay, in 95% of cases, you never lose more than 5 million, granted. But what happens in the other 5%? That's the key. It can be 5.5 million or it can be 500 million. There is no prediction whatsoever. This is the biggest limitation of value at risk, and the reason why it's been called, in a beautiful analogy by an analyst, an airbag that only works when you don't have a car crash. It's also important to understand that it averages out internal risks. VAR is a black box. So if you have 500 million in a big long position and 500 million in an opposite short position, their risks average out. And VAR considers there is zero value at risk. So it doesn't represent the internal risks, only the summary. It also grows exponentially more complex and harder to calculate with a large number of positions or funds, especially if they're correlated. In fact, for hedge fund investors, it's completely reasonable that they know the VAR for every fund, but it's impossible for them to know their total VAR. Precisely due to these limitations, there are other measures used to calculate risk. The first is standard deviation. It's simply the standard deviation of returns for a fund. The variability, it's a good measure of whether the returns are constant and predictable or not at all. As you probably know, downside deviation is a variation that only measures the losses and not the returns. So if there is variability in terms of excess returns, that one is ignored here. Only variability in terms of losses is considered. And if you're familiar with the Sharpe and Sortino ratios, you've probably realized by now that they are just the returns divided by these. The Sharpe ratio is the returns adjusted for the standard deviation, and the Sortino is returns divided by the downside deviation. Another measure is the largest losing month, or just the largest loss, also called a drawdown. It simply measures the largest losing month that a fund has ever had, or the largest loss itself. For example, regardless of the possible spectacular returns of a fund, if it had at one point a 20% loss as the biggest one ever, then investors are going to think twice. Then, the number of months to earn back a loss. By this I mean, for every month that had a loss, how long does it take for the fund to earn back the lost capital? It may be 2 weeks, it may be 2 months, or it may be 2 days. Naturally, this period is going to be bigger if, number one, the losses are big, or if the performance after a loss is weak. And finally, just the actual percentage of months with losses. Simply judging statistically out of all of the months where a fund has been operating, how many were positive and how many were in the red. Naturally, none of these is a silver bullet, but they are additional tools that help allocators have more transparency because metrics like value at risk are a complete black box. Also, there are individual risks to hedge funds. As we saw, there are 3 layers of risks: market risks, secondary risks, and idiosyncratic risks. These are risks that have to do with any investment vehicle. But there are also risks that don't have to do with the securities or markets, but with the actual operations of a hedge fund. And these may include, number 1, position concentration and client concentration risks. Position concentration has to do with having too much capital in a few positions. If you have a $100 million fund, but $20 million is locked in one single position, that's 20% of your fund. If that goes bad, so does 20% of the whole fund. Client concentration has to do with allocators. If you have a $1 billion fund, but half of the whole fund is from just one allocator, if that particular client redeems their money, you are gutted. Then, counterparty risk. What happens if a prime broker or service provider fails, like Lehman Brothers did? Also the reason why institutional investors demand multiple service providers. Then, unhedged position risk. Having too much capital in positions that are not hedged and that can go wrong. For example, if you have a 300 million position in a tech company that is long, maybe you can find a short play in another tech company to hedge against some of the risk. But if you only have that long position, if it goes bad, you have no hedge against it. And especially if that position is levered, this can go wrong very quickly, which is a good segue to leverage risk. How leveraged the fund actually is. It can be levered 2 to 1, 3 to 1, 50 to 1, or any other measure. Naturally, the bigger the number, the more dangerous. Because if levered positions fail, your losses are going to be huge and possibly fatal. Then, liquidity risk. What happens if the fund has a liquidity problem? For example, a levered position blows up and the fund can't finance the loss because their assets are not liquid. Or if the fund's investors have a liquidity crisis themselves and they have to redeem, but the fund just can't provide the money. What are some examples of metrics and indicators? The first is funds themselves. As we've seen, VAR has a problem with a large number of positions, being very hard to calculate due to the correlations between positions. Which is why, when it comes to funds, it's even worse. Allocators have individual VARs for the funds that they invest in, but they have no idea of their total VAR, because in order to calculate it, they would need real-time, full transparency on all positions of all funds at the same time, which is pretty much impossible. Then, even VAR can be manipulated. It depends on a Gaussian distribution, a normal curve. Therefore, by manipulating the curve, you can change the confidence level and the values for loss. And finally, some measures are focused on volatility and some are focused on the numbers. You will notice that both standard deviation and VAR are based on a normal distribution. But while the standard deviation focuses on the volatility or variability, the VAR focuses on the actual price tag of that loss. What are our key takeaways here? The first is that VAR, or value at risk, is the most known and widely used measure for risk. But it doesn't mean that it's a good one. It tells you the maximum loss for a given confidence level, a probability, but it makes no prediction outside that confidence level, and it grows exponentially more complex with more and more positions due to their correlations. Then, there are other risk measures to make up for VAR's shortcomings. These are related to the biggest losses, to recovery periods from losses, and loss percentage, or just the actual deviation of losses and returns. Then, there are unique risks to hedge funds based on their specific operations and tools, including position concentration risks, leverage risks, unhedged position risks, and more that must be addressed. So as we see, there is a set of unique risks to hedge funds, including counterparty risk, leverage risk, liquidity risk, and many others. And there are indicators that can measure that risk. VAR is good, but it has severe limitations, which are important to understand. And there are other indicators, such as months to earn back a loss, the biggest losing month, and others that precisely help investors gain transparency that VAR doesn't provide.